Hey, welcome back. It's Jason Walter here. Mortgage interest rates are about 2.78% right now, and they haven't been this low since February. Rates are not too much higher than the all-time record low of around 2.7% that was set in early January. And because of this, there's a recent surge of homeowners looking to refinance their mortgages. For example, the Mortgage Bankers Association announced today that mortgage applications increased 5.7% from 1 week earlier, and that increase was mainly due to a 9% rise of mortgage applications for refinances. Joel Kahn of the MBA stated the following: the 10-year U.S. Treasury yield fell last week as investors grew concerned about increasing COVID case counts and the downside risk to the current economic recovery. Refinance applications jumped as a 30-year fixed-rate mortgage declined to its lowest level since February 2021, and the 15-year rate fell to another all-time record low dating back to 1990. Refinances for conventional loans increased over 11%, and with over 95% of refinance applications for fixed-rate mortgages, borrowers are looking to secure a lower rate for the life of their loan. In addition, the Federal Reserve met today and they announced that they're keeping the federal funds rate near 0%. This rate is tied loosely to mortgage interest rates. At some point, the Fed is going to raise rates, and that could potentially increase mortgage interest rates as well. However, just because mortgage interest rates are near historic lows, and they are going to remain that way probably for some time, this does not mean that everyone should refinance their mortgages. So in today's video, I'm going to be discussing 5 reasons why you should not refinance and some common pitfalls you should avoid, which ultimately would save you a lot of money. And before we get started, please hit the like button. I greatly appreciate that, and also consider subscribing as well. I post frequent housing market updates and everything real estate related, so you can make a more informed decision about whether to buy or sell a house or refinance your mortgage. And check out the link below if you want a real estate agent referral for virtually anywhere in the United States. My first reason why you should not refinance is when you pay too many points to get a good interest rate. As you may already know, points are fees you pay up front in order to reduce your mortgage interest rate. So for example, 1 point is equal to 1% of the loan balance. Therefore, 1 point on a $300,000 mortgage is equal to $3,000. Therefore, when paying points in order to reduce your mortgage interest rate, that effectively increases your closing costs in order to get the loan. And if your closing costs are too high, then it may take a long time for you to break even if your mortgage payment goes down substantially after you refinance your mortgage. That leads me to my second reason why you should not refinance your mortgage if it's going to take too long to break even. Refinancing your mortgage is definitely not free. So there are some closing costs associated with doing that, but a lot of people really don't see this because usually those closing costs are added into your loan balance. So here's what I would recommend, and this is exactly what I did when I refinanced my mortgage last year. So number 1, calculate the total number of closing costs in order to do the refinance. These would be charges such as an origination fee, an appraisal fee, recording fees, title and escrow fees, and any prepaid fees such as prepaying your property taxes or insurance. In order to determine your total closing costs, ask your loan officer or your lender for a loan estimate. That lists all your closing costs associated with doing a refinance. When shopping for lenders, you can ask for this document so you compare lender to lender to make sure you get the best deal. The second step there is to calculate how much money you would save on a monthly basis after doing a refinance. Take your current monthly mortgage payment and subtract what your new payment would be after you refinance your mortgage. And number 3, take your total estimated closing costs and divide that by your monthly savings. This will give you your break-even point. Let me briefly share an example. So let's say your total estimated closing cost is going to be $10,000. And let's say you're going to save $200 per month if you do a refinance. Therefore, it would take you approximately 50 months in order to break even, or just over 4 years. So here's the key point in that example. It would not make sense to refinance unless you're absolutely confident you're going to be living in that house for at least 5 years. If you were to move less than 50 months after you refinance, that's going to be a ton of time wasted and a lot of money wasted as well. Therefore, before you apply to refinance your mortgage, definitely calculate your break-even point so you can determine how long you actually have to live in the house in order to recoup all those closing costs you paid. On a side note regarding closing costs, a new fee was announced in August of 2020 for homeowners who want to refinance their mortgages. That new fee was equal to 0.5% of the loan balance for the majority of Fannie Mae and Freddie Mac refinance loans. So for example, for a $400,000 loan, that would be equal to $2,000 in additional fees. However, I noticed a couple of weeks ago that this fee was actually eliminated for mortgages backed by Fannie Mae and Freddie Mac, effective as of August 1st, 2021. It stated the following: FHFA's expectation is that those lenders who are charging borrowers the fee will pass cost savings back to borrowers. Despite the cancellation of this adverse market fee, here's a third reason why you should not refinance your mortgage, and this is for a cash-out refinance. First, let me briefly explain what a cash-out refinance is. So this is when you refinance your original mortgage loan and replace it with a larger loan balance, and you get cash back, which comes from the equity that you have in your home. One of the downsides of doing a cash-out refinance is that your mortgage interest rate is higher versus doing a regular refinance. Plus, you end up paying interest on the cash that you receive because your loan balance increases. In my opinion, one reason why it may make sense to do a cash-out refinance is to eliminate high-interest debt. So for example, credit cards. For example, the average credit card interest rate right now is around 18%. So if you have a large credit card balance that has a very high interest rate, it may make sense to do a cash-out refinance and replace that high interest debt with low interest debt. And of course, do not use this as a crutch. Instead, focus on being financially responsible and do not spend more money than you actually have, if possible. On the other hand, it's a very bad idea to get cash out and buy a boat or a Lambo. Believe it or not, a lot of people do cash out refinances and buy frivolous things, so avoid temptation. This actually happened during the Great Recession where home prices fell, a lot of people lost their jobs, and they lost their boats. A fourth reason why you should not refinance is when you're close to paying off your mortgage already. So for example, if you only have, let's say, 5 years left on a 30-year fixed rate mortgage, it does not make sense, or it possibly would not make sense, if you were to refinance and get a brand new 30-year fixed rate mortgage, because you're ultimately going to be paying a lot more in interest in order to have your house. A fifth thing to avoid is to refinance into an adjustable rate mortgage, or an ARM. And this is a more risky loan product because your interest rate can fluctuate over time, unlike a 30-year fixed rate mortgage. For example, maybe you have a 5-year ARM, which means that you have a 5-year fixed rate mortgage, but after that 5-year teaser period, your interest rate becomes variable and it can fluctuate when mortgage interest rates fluctuate. Therefore, your mortgage payment would also fluctuate. This, of course, was a common loan program that was used in 2005 to 2008, but thankfully it's not used very widely right now due to all the risks involved. For example, the Mortgage Bankers Association announced today that the share of mortgage applications last week for ARMs only made up 3.6% of all mortgage applications. When you compare that to mortgages originated in 2005 to 2008, approximately 50 to 80% were using ARMs, and most of those were interest only. So no wonder the housing market crashed in 2008 when interest rates skyrocketed. Click on the links below if you want 2 free stocks for a limited time. Also, if you want a real estate agent referral for virtually anywhere in the US, check out the links below. Also, if you got any value out of this video whatsoever, then please hit the like button. I greatly appreciate it. Also, you can follow me on Instagram. I'm Sacramento Realtor. Hope you have an awesome day, and I look forward to seeing you on the next video.